Hello everyone, welcome to this training course on financing for disaster and climate resilience. In this module, we will be talking about climate finance and global architecture related to climate finance. I'm Raju Pandit Chatri and I will be leading this session. The expectation is that this module should at least discuss about the basics of climate finance, the genesis of climate finance, and also in relation to the Paris Agreement and the UN Climate Change Convention. But of course, we'll be also discussing a little bit on the financial flow, the mechanism, and how the climate finance works. Before I go into the details of climate finance, I wanted to have a little context set here. And this is in relation to the United Nations Framework Convention on Climate Change. We know that this is the mother convention for dealing on climate change and climate actions. And this has very clearly indicated that we are supposed to tackle the growing greenhouse gas concentration in the atmosphere. And while we say this, of course, one of the principles that the convention has really set is, the context where it talks about common but differentiated responsibilities and respective capabilities. And this is a principle that is very strongly embedded here. I say this because this will lead to other aspects in the coming slides. Now, when we talk about this, there are responsibilities we should take and who should act on climate change. Of course, it does talk about everybody having to do the work in order to really tackle climate change. But at the same time, the responsibilities lie quite strongly with the ones who created this problem, and especially the developed countries. In 1997, when this convention really didn't deliver much, then we had Kyoto Protocol. But again, the Kyoto Protocol also did not lead us to much action. Hence, in 2015, we had this new agreement called the Paris Agreement. Now, in this Paris Agreement, there are 5 key elements. Because in the past, the countries did not act as they agreed in the convention or the Kyoto Protocol, the Paris Agreement gives the opportunity as a top-down approach, but at the same time, bottom-up approach. So the two mixture of those two essence is what is driving the Paris Agreement's implementation. I said that precisely because there are 5 key elements. One, it sets the temperature goal that we want to reach by the end of this century, 2 degrees. But now what we are saying is 2 degrees is too much and we need to have 1.5 degrees Celsius by the end of the century. In order to achieve that, we have a milestone set by 2015 to achieve net zero emission. But again, whether those milestones are being really achieved or not, whether we are in track or not, then we do the 5 years review cycle, which means also relates to the global stocktake. In fact, in 2023, this year, we'll be doing that cycle, the stocktake of the implementation of the Paris Agreement. Now, in order to have this really implemented, the actions taken forward, climate finance is one of the important elements of this Paris Agreement. Now, this is a part of the means of implementation. It comes along with technology and also the capacity building. But without finance, without the adequate finance being mobilized, then achieving the Paris Agreement is difficult. Hence, though this is a legal instrument, but it does not really, has a very legally binding aspects of it. And so what we often say is the morally binding aspects. And it has very clearly said who should do what. So in that context, now let me just come to the climate finance, where I will dwell into the essence of how the climate, what is it, and how do you look into it, what are the different elements of it, and how do we move forward with the understanding of climate finance. As I said before, the climate finance component is very much embedded in the heart of the convention. If we look at the Article 4 of the Paris Agreement, it very clearly says that the developed countries should provide finances to the developing countries in order to help them take climate actions. The lead, of course, should be taken by the developed countries to address climate change, but at the same time, if the developing countries are to support in that line, then they should be provided with the adequate means of implementation, finance, technology, and capacity building. And here we will mostly talk about the climate finance part. It very also clearly sets that the resources that will be provided by the developed countries to the developing countries will be new and additional. This comes in a context that, for the last many decades, development aid has been provided with the official development assistance, 0.7% of the GNI of the developed countries going to the developing countries for development work like infrastructure, health, education, peace building, and other aspects. But the climate finance is an additional responsibility of the developed countries to support the developing countries. That's where is the core, and there is a strong obligation of the developed countries in meeting that and providing support to the developing countries. Under the convention, in Article 11, the financial mechanism has been created. This is precisely to say that how will the resources be supported to the developing countries? And it very clearly says the financial mechanism has been set up there, and any operating entity or the entities decided by the under the financial mechanism will help support the developing countries' actions on climate change. That may be through the bilateral, regional, or multilateral channels. So that's what the convention very strongly talks about in brief. But again, when it comes to the Paris Agreement, this climate finance is also very much embedded in the heart of Paris Agreement. There are two aspects on this climate finance. One, which is already mentioned in the objectives of the Paris Agreement, which is the Article 2 of the Paris Agreement, where it talks about the global goal, also talks about, which is related to mitigation, 2.1a, 2.1b is related to the resilience building, and 2.1c is related to the financial flow, which very clearly says that, Article 2.1c is, which says that making financial flows consistent with a pathway towards low greenhouse gas emission and climate resilient development. It means that all the countries party to the Paris Agreement will abide or will fulfill in meeting the objectives of the Paris Agreement, which literally means that developed and developing countries will take this 2.1c ahead so that we are in line with meeting the objective of the Convention and the Paris Agreement. The second part is the Article 9 of the Paris Agreement, which is the finance-related article. And this is related to the provisions and mobilization of climate finance from developed to developing countries. So it very clearly says that developed country parties shall provide financial resources to the developing country parties. Of course, it also asks others, it encourages other countries to provide finances, but it is the sole responsibility of the developed countries to provide that financing. Now we will have heard about this, a lot of the talks on the 100 billion goal. When the 100 billion goal was decided in 2009 in Copenhagen at COP15, there were two aspects of this. One, they call the fast start finance, which was 30 billion US dollars from 2010, 11, and 12. And the other aspect was the long-term finance, which they said the $10 billion per year for 3 years would scale up all the way to 100 billion US dollar per year by 2020. And that is where we talk about the 100 billion goal and whether that has been achieved or not. I will come to that slide a bit later. I have a little detailed information on that. But that is where we said today that there's a clear indication of the number that developed countries are supposed to provide developing countries with 100 billion US dollar per year by 2020. And now when you decided in the Paris Agreement in COP15, there was also decision that the 100 billion would be from 2020 to 2025, and in 2025 we'll set a new goal based on as a floor, taking the 100 billion as a floor. So this is what has been decided. And of course, this resources is just not about providing it, but the access of the resources by the developing countries has to be very simplified. It should be accessible. They should be sufficient enough to take to meet the needs of the developing countries, but also it should be led mostly by the public money, and the grant-based resources should be, especially for adaptation, because in the context when there is no return, then developing countries, especially highly vulnerable and low capacitated countries, can be doubly penalized, because if you provide financial loans to them, then on one hand they have been suffering from the impacts of climate change, on the other hand debt burden is a big issue. Now, having said that, what is set in the Paris Agreement and the UNFCCC, now we talk about what that exactly the climate finance really means. Now, when you talk about the climate finance, there is no globally agreed definition. The Standing Committee on Climate Finance has been given the task for several years now to come out with a definition, but there's been no agreement on that. But literally, the climate finance, the way the UNFCCC defines is, it's whether it's local, national, or transnational financing, which may be drawn from public, private, and alternative sources to address climate change. It means that when you talk about addressing climate change, there are two aspects of it. Either you reduce greenhouse gas emission, or you adapt to the adverse effects of climate change. That is where we take it as a central to saying that any resources that we get from any sources, but if we're taking it whether to reduce emission or to adapt to the adverse effects of climate change, then we literally say that is the climate finance resource. Now, in order to really qualify this, under the Paris Agreement and the Convention, three elements have been clearly identified. One, we call it nationally determined contribution. And the Article 4, of course, like under that, every country will have to provide its nationally determined contributions at least for 5 years with the long-term plan for 10 years so that they can review after 5 years. So this is what is going to determine the implementation of the Paris Agreement in terms of mitigation actions and reaching to the 1.5 degree goal of the Paris Agreement. Now, this is something that all the countries have really prepared and submitted. Whether it is up to the mark or not is a different question, because last year the UNFCCC made an assessment that even if we implement all the nationally determined contribution, we will still hit to 2.5 degree or beyond world by the end of the century. Why I refer to this here is because this is directly related to the climate finance goal. Most of the developing countries have prepared the NDCs with two conditions. One, what they have said, because this is a nationally driven conditions, they will take actions without international support. But there's a lot of conditions in these NDCs that they will only implement those NDCs if the resources are being provided by the international entities or the developed countries, let's say. So that without that, most of the NDCs will not be implemented, and they're quite ambitious as well. This is, though it doesn't refer these sectors, but when we talk about NDCs, it's mostly focusing on the mitigation side. But at the same time, in order to achieve the resilience side of the climate actions, developing countries have also been asked to submit the national adaptation plans. And this is basically to reduce vulnerabilities to the impacts of climate change. And under the GEF, Global Environmental Facility, and the Green Climate Fund, the countries have even been offered up to $3 million to prepare their national adaptation plans or adaptation planning process. It means that any climate finance that may flow in the future, either for adaptation or mitigation, will be based on these plans that has been supported. So the finance is a very key driver in moving and implementing these nationally determined contributions. But there's also the another aspect, the third pillar of the Paris Agreement, which is Article 8, in fact, and this is the loss and damage part. Now, loss and damage must, of course, address both the extreme events and the slow onset events. Under it, both the economic and non-economic losses. But the loss and damage financing has been not considered for a very long time. It was only last year at COP27 they decided to establish a loss and damage fund, or the financing mechanism for the loss and damage. And that is still in the making now. But having said that, this will be one of the elements where in the future getting a lot of tractions to finance loss and damage, especially when there are extreme events, the countries will be supported, or their rehabilitation, or if there is non-economic aspects like cultural loss, tourism, and other things. In order to address that, the climate finance should also address this aspect. Now, if we talk about these three major overarching aspects of national NDCs, NAP, or loss and damage financing, countries have provided, or countries come up with their own national priorities based on these plans. For instance, now you can always relate, different countries have their own way of dealing with certain things, because when these overarching frameworks or the documents have been prepared and submitted to the UNFCCC, that is what is going to guide the implementation or the financial resources in the future, that countries have also have their own national policies, strategies, plans, and programs. It could be either in the sector that is related to the resilience building, or mitigations with the sectors that they prioritize, they think that it is important for their own countries need in order to address that and also lead to the sustainable development. I talk about the capacity building, which is in fact the Article 11 of the Paris Agreement, and Article 10, which is the climate technology. All these aspects are very key in taking climate actions. So when you say that, if we have a proper national plans, policies leading to the implementation of the NDCs and NAPs and loss and damage, in fact, that is where the project pipelines will be created, where the investment plans will be made, and it is easier for us to really have a say to say that this is where we need climate financing. And one of the things that the Standing Committee on Finance has also done is, what are the needs, financial needs of the developing countries? Based on the NDCs and the costing of the NDCs and the NAPs, National Adaptation Plans, in fact, the UNFCCC, under this, the Standing Committee on Finance, even has done a first need assessment report saying that, okay, countries have prepared their national plans and the NDCs and NAPs, but what will be the future financing needing in order to implement those? So where those resources will come from? How much of the resources the countries will themselves bear it? But how much is that is expected from the developed countries or the other institutions? That is what is going to really drive this climate finance. Now, one may be wondering, like, if anything that is being invested is, how do you say that what is climate actions or not? Then in order for that to really take into account, I'll give you the examples of a Green Climate Fund. The Green Climate Fund, as whenever we submit a project to the Green Climate Fund, which is Green Climate Fund is the now the biggest global multilateral fund, which is providing resources for climate actions to the developing countries. But what the GCF really defines is to say that this is a mitigation project, to validate that any actions taken will be a mitigation project. They bring in the indicators like, how much of the CO2 equivalent tons of greenhouse gas has been really reduced or avoided. That is what they take it as a very straightforward element or the indicators to say that this is a mitigation project. Either the cost to be invested in a way that it reduces or avoids the emission, greenhouse gas emission. Or if it is already emitting, then we also supplement or let's say replace that with something else. The other part is quite complicated, is on the adaptation indicators, and it talks about the total direct and indirect numbers of beneficiaries that have been benefited of the project, and the adaptive capacity of those population has been really raised. That is what it takes, and adaptation indicators of how the climate finance is really going. So when the actions are being taken at the national level by the local entities, by their own resources, or the resources coming from the international context, then the decision to say that whether this is a climate finance or not is whether it's avoiding GHG emission or reducing it, or is it building the resilience capacity of the communities or people or not. And that is the basis where I think this is something that even other now entities are gradually taking into account. So if we look at the climate finance from various perspectives, I give you a very quick snapshot of what the convention says and where the Paris Agreement is lying and how we are moving forward in terms of what the elements of the climate finance are. Now let me briefly touch on the flow of climate finance, looking from the governance and the international context. Now, when you talk about the flow of finance, we'll have to always remember and go back to the Paris Agreement's major element. I talked about two aspects. One, I talked about Article 2.1c of the Paris Agreement, which is in the objective. It is the making financial flow consistent with the low carbon and climate resilient development. The other one is the Article 9, which is the provision of finance, provision and mobilization of finance from developed to developing countries. Now, I'm just reminding that basically because when you talk about the flow of finance, we look into these two aspects. One, globally, where are the assets sitting? Where are the resources really sitting? Now, I've taken it from the biennial assessment report of the UNFCCC, which is prepared by the Standing Committee on Finance in 2020. In fact, this came out in 2021, but every 2 years the report comes out, how much resources have been mobilized by the developed countries. Now, in this report, it talks about varieties of sources here. Now, if you look at the bottom side on the stock, we have been trillions, hundreds of trillions of dollars sitting there in various forms, whether they are in the capital markets, whether they are in stranded assets, whether they are in the form of fixed assets, and whether they are in the assets under management by various institutions and in lot in diversity. Now, there's a huge resources sitting, but if we want to move towards the low carbon and climate resilient development, that flow, then we'll have to shift the global financial flow in a way that this is becoming a green finance. Now, if we get to the little and the core of this, it's very interesting to note that still huge amount of resources going into, if you look at the flow, it is going into the fossil fuel subsidy, for instance. This report itself says in 2018, almost 472 billion were spent in fossil fuel subsidy, whereas the total climate finance flow in terms of going forward was only about 775 billion. Now, similarly, there are also, of course, resources going into energy sector, investment in the deforestations, and trying to move away from the current high carbon intensity to low carbon sectors, but at the same time looking at the agriculture sector, or trying to also see that the investments are being looked into from the insurance perspective. And so there's a huge amount of flow look into different, and this flow is supposed to be both north to south, south, all directions, south, north, all directions. So this is the total flow. But now when you say that, now the 100 billion I mentioned earlier is going to be a very little peanut up to what we need really to move in order to achieve the Paris Agreement objectives, which is like, trying to move the entire portfolio of various assets sitting there to say that we are going into a direction where we need to achieve the objective of the Paris Agreement of 1.5 degrees. But unfortunately, that is quite not happening. And we know that is still the fossil fuels are being explored. Even recently, we have heard that even a country like UK that was being seen as a climate leader is now opening up to fracking in the North Sea, and so on and so forth. So this is happening all over the world. Now, if you see the OECD report of the 100 billion, particularly I want to come in the 100 billion, the goal that the developed countries were supposed to meet from 2020 to 2025. We are here in 2023. This comes in every lag year, and we have the data for 2020 now, but soon there'll be data for 2021. But now the countries in 2020, only about 83% has been met. In the $83 billion have been provided. This is according to the data provided by the OECD in its own report. Of course, the sources are coming from bilateral public finance, multilateral public finance, export credits, and mobilized private finance, because this is supposed to be also be mobilized from the private sector. Now, of course, we can always debate about whether this 83 billion that has been recorded are the true climate finance or not, because there are a lot of the other reports that says this amount, resources have been distorted in a way, because not everything is climate finance, but this has been overlapped or double counting with the ODA resources. But in any case, developed countries, as per the Paris Agreement, were supposed to meet the $100 billion by 2020, and this has not been met. And there's also a little confusion that sometimes that all the resources of the $100 billion per year is going to the Green Climate Fund. Unfortunately, that is not the case, and I will come to the Green Climate Fund. But to say that in 2013 they started with $52 billion, and in 2020 going all the way to 83.3 billion US dollars. And they have promised that they will soon meet this target. But one thing we'll also have to note when you talk about this is the resources going to the developing countries was supposed to be balanced between adaptation and mitigation. But unfortunately, it has been very skewed towards the mitigation actions. Almost 70% goes to mitigations and only 30% goes to adaptation actions. In fact, a lot of the now developing countries are demanding that adaptation actions are being supported because of the growing climate impacts everywhere in agriculture sector, the different disasters taking place, in a lot of devastation taking all around the world. In fact, in COP26, that is the reason why there was a decision that the adaptation financing would be doubled by 2023 in order to really look into, based on the 2019 levels, to see that the skewed nature of the financing would be somehow try to balance that. Now, but when you look into this, what are the things that I wanted to really focus, and I'll take a little bit of time, is now if developing countries were to really access resources, then what are the mechanisms of that? Now, when you talk about the developing countries accessing the mechanism, one, as I said earlier, we have it under the conventions. There are certain operating entities of the financial mechanism established under the convention and the Paris Agreement. For instance, Global Environment Facility, that was long back in 1995-96, this Global Environment Facility was nominated as the operating entity of the financial mechanism. Underneath, in 2001, two special funds were even created. One was Least Developed Countries Fund, especially to support least developed countries, and the other one is Special Climate Change Fund for all the developing countries. That's where, of course, now these two, apart from the trust fund of the GEF, the Global Environment Facility. Now, these funds do not have a sources of themselves, so they usually depend on the voluntary pledges by the developed countries. The other fund that was created in 2010 is called the Green Climate Fund. I'm sure that most of you must have heard about this fund, which is now into its in this year there will be a second replenishment for this fund. They are expecting at least about $12 to $15 billion to come in. This will be in October. The Germany will host the replenishment for this, and the interesting part is this is one of the funds that is where the developing countries can have access to these resources through various means. Either they can nominate their own national entities and get accredited and then get the resources, or they can also apply through the internationally accredited entities like the UN agencies, MDBs, and other international organizations. So in order to have that, one of the beauty of this fund is also that it also gives readiness and preparatory support, so the countries can themselves build their capacity, institutions, put their policies, make investment plans, or let's say the project pipelines in order, and do the stakeholder convening, and then build funding proposals and really work and in a more country-owned and in a country-drivenness nature. The other fund is the Adaptation Fund. This was created under the Kyoto Protocol when we had the Clean Development Mechanism. The 2% levy of the CDM projects would go into this, and that would fund the adaptation projects in the developing countries. Unfortunately, the CDM mechanism has almost failed, and now this is depending on the voluntary pledges of the developed countries. Every COP that there's a pledges going to the adaptation fund, but this only funds up to $20 million per country project. And the other one, of course, now this is also serving the Paris Agreement. So that's why it's important that in the future that if this grows, then it is a very specialized fund in the adaptation, and it can support the developing countries. The third I would want to talk about is the Loss and Damage Fund. This was decided last year in COP27 in order to finance the loss and damage actions. But of course, this is now the transitional committee is still working on it, and they're supposed to operationalize this fund by the expectation is by the end of this year, at least in COP28, the decision should be taken place there. But apart from that, we also have the other international sources. Not every climate finance flows through the mechanisms under the Convention of the Paris Agreement, because even the 100 billion goal that I talked about, there are a lot of the resources going through multilateral development banks. The bilateral funding the countries have been providing through their own institutions. There are dedicated climate funds like the Climate Investment Fund, where the pilot project for climate resilience or scaling up renewable energy or forest investment programs were all created. And there's also this renewable energy fund being under the SIF that is being put in place. So we have these different multilateral climate funds, but also we also have UN agencies mobilizing climate finance resources. At the same time, we have international organizations and philanthropies now providing climate finance. But one of the major sectors is also the private sector institutions, banks, private banks, or the commercial banks. They're also moving into this, investing now, because, as I said earlier, that if we are to achieve the goal of the Paris Agreement, the making financial flow consistent with low carbon and climate resilient development is very key. Without that, without everybody trying to embrace it, we will not be able to achieve that goal. So in order just waiting under the Article 9 from the resources from the developed to developing countries to flow, that alone will not suffice that. So every country will have to work, and when you say every country, of course, the entities within or between them also will have to work. And of course, other one very strong aspect is also that the carbon markets will be the source in the future. Of course, the CDM did not work very well, but in the future, when the countries have not done their fair share, or they are unwilling to do on their own part, but then buy the carbon credits from the other countries, then this market is expected to grow. Now, the article that deals with the carbon markets, the Article 6 of the Paris Agreement, which has not yet come into implementation. So once this comes into implementation, the expectation is that the carbon markets will really grow, and the finance will also flow based on the selling of the carbon credits. So this is also one of the sources. But having said this, there are also a lot of challenges. Developing countries want resources, the financial resources provided by the developed countries, either into their budgetary support or directly supported to their national institutions. However, there are also a lot of tussles going on. Who should provide these resources? Should we use the UN agencies? Should we use as a channel of the international organizations? To the MDBs themselves deal with this kind of. Now, all the MDBs are having their own climate action portfolios. They have allocated the resources. We know there's a lot of talk about world banks and MDBs, in fact, being reformed, because one of the aspects is that many of the countries during the development process have already been highly indebted. And even under the climate change works, the financing of the climate actions, the developing countries are having to take loans instead of getting grants for climate action. So in addition to that, their indebtedness is extremely growing. And these institutions were created almost 60 years back, or 60, 70 years back, in that context to deal with the development. Now, in order to make them fit for purpose for climate actions, the reform of the MDBs are also being sought at this stage. So there's a lot of discussion going around this. And if that happens, basically to really help developing countries meet their climate actions, implement the NDCs, implement the NAPs, build their climate resilience, and also support them in the sustainable development without putting them into debt burden. That is the essence of this. And I think all the countries are gearing up for this. Now, if these were the channels, there are also a lot of instruments that is being used, as I said, that I just explained. And these instruments, of course, now it depends on what kind of projects, what instruments are being used. Different. There are also equities there. Concessional loans have been provided, guarantees and risk transfer. Green bonds have been quite a attraction at this stage, that the bond is being floated so that the more resources are being generated to invest in the green investments. There's especially the low capacity countries are demanding high grants in projects where there will be no returns, especially in extreme events, whether if it is to do with the loss and damage financing, then the extreme events will have created a lot of damages, and it is very difficult to pay back. So in that particular context, grants are being demanded. by the developing countries, but also mostly for adaptation and loss and damage projects. But different kinds of instruments are there. But while the instruments are being used, it has to be used very judiciously. Otherwise, the problem is if the countries do not choose their instruments of climate finance wisely, then again the indebtedness is going to be extremely difficult for them to pay back in the futures. So any grants or any amount that is being sought, whether it's from the multilateral development banks or the funds like Green Climate Fund or other sources, what kind of instruments that they want to use is the choice, and let's say the opportunity has to be given to the countries to make their choices. So that's what one of the fundamentals of this. But the instruments are being quite a lot, and they're also diversifying these instruments to support climate finance in the current context. So in order for me to just quickly wrap this up, I would say that the sources of finance, if we want to take climate actions, are either under the Convention on the Paris Agreement or to the other international sources. There are varieties of sources existing in the international context. But of course, it is for the countries that how they want to take their climate actions going forward under the NAPs or under NDCs, and contribute to the implementation of the Paris Agreement, because now almost all the countries have committed to implementing the Paris Agreement. If that is to be taken seriously, not having adequate access to adequate climate finance, easy access, let's say the adequate access by the developing countries, then their actions will only remain in the papers. And in order to translate those plans and policies and programs into actions, financial resources will be a key factor. Otherwise, we make plans, we continue to build an ambition to say that we will do this and that, but without the availability of resources, those plans will not translate into actions. And for that very reason, as I mentioned, the responsibilities of the developed countries to provide to the developing countries, also the responsibility of the developing countries to adequately trickle down to the local communities and then support the communities on the ground is very key. Only then the essence of climate finance will come into making. Otherwise, we have a lot of learning from the development sector to learn, to say that what works and what doesn't work, what kind of methodology or what kind of modalities of financing will work and will not indebt countries or will not put the communities into difficult situation. I think that learning has to be made. I think climate finance is one of the priority areas where we can really drive our sustainable development, and also while working into climate actions, looking at both the mitigation and adaptation sides, and then contributing to the objectives of the Paris Agreement. With that, I end here, and thank you very much for your attention.